Have you ever wondered why a currency can just, suddenly crash, even when all the financial math says it should be going straight up?
Right.
You look at the screens, the interest rates are sky high, the macroeconomic spreadsheets say it's an absolute sure thing, and yet the bottom just falls out completely.
It defies all logic. It defies the logic we are usually taught to believe when we first look at global finance.
Exactly. Our mission today is to do a deep dive and pull back the curtain on this multi-trillion-dollar machine.
We are talking about an arena where over $7 trillion change hands every single day.
Which is just a staggering number to wrap your head around.
It really is. It is the largest, most deeply liquid financial ecosystem on the planet. And yet, the way it is explained to the public, and even to many professional investors, is often completely stripped of its true mechanical reality.
Yeah, we are fed this surface-level narrative about interest rates and simple yield that completely misses the hidden structural forces that actually dictate where the world's wealth is moving.
We are going to decode the secret language of global money flows today. By the time we wrap up this conversation, you are going to be equipped with the exact mental models used by top-tier institutional investors.
The goal is to help you see the matrix of global capital.
Framing it as a matrix is highly appropriate. To truly understand the trajectory of global capital, you have to hold two seemingly contradictory concepts in your mind simultaneously.
Right, you need a firm grasp of the basic yield-driven math that attracts the broader masses of the market.
But you also must understand the massive structural incentives that drive the absolute apex predators of the financial ecosystem.
We are talking about global macro hedge funds, sovereign wealth funds.
The giant asset managers that do not just participate in the market.
They create it.
Exactly. They create the market.
So let's start with the surface story. The intuitive math that drives so much of the daily commentary. In the institutional FX world, this is known as the carry trade, or operating within a carry regime.
Let's look at the baseline mechanics of this, framing it the way a global macro desk actually operates.
Yeah, instead of an oversimplified analogy, let's look at the actual plumbing.
An institutional desk borrows capital in a structurally low-yielding environment, say, issuing short-term commercial paper in Swiss francs or Japanese yen.
Where the cost of borrowing is practically zero.
Right. Then they take that massive, cheap liquidity, convert it, and buy sovereign debt in a higher-yielding environment, like Brazilian government bonds yielding 8 or 9%.
They are capturing that yield differential.
The underlying mechanism there is driven entirely by central bank policy and the fundamental rule that capital naturally flows toward yield.
A prime broker facilitates the leverage, right? Allowing the fund to amplify that seemingly small interest rate spread into a massive return on equity.
The central bank policy decisions and government bond yields act as visible, quantifiable magnets. If one nation offers a significantly higher risk-adjusted yield than another, international capital will naturally rotate toward that nation's financial assets.
It's highly rational. It's a mathematically sound approach to generating returns.
On paper, yes.
But that assumes a perfectly rational market, doesn't it? If capital purely followed yield, emerging market currencies would constantly be the strongest in the world.
Which we know is not the case.
Right. Because the actual mechanics of this trade create a massive behavioral feedback loop that skews the rationality.
Think about the psychology of a portfolio manager.
If every other fund is generating massive returns by borrowing cheap yen and buying high-yield Mexican pesos, and you are sitting in cash, you are facing severe career risks.
You jump in.
You jump in. And as more and more institutional capital piles into that specific high-yield currency, the sheer volume of buying pressure causes the currency itself to appreciate.
That introduces the concept of the self-fulfilling prophecy. This is the momentum engine of a carry regime.
The dynamic shifts from a simple yield collection strategy to a dual-vector profit engine.
Suddenly, the institutional investor is not just earning that 8% interest rate spread. The principal investment is also growing because the target currency is appreciating against the funding currency.
The portfolio manager is winning on the interest yield, and they are winning on the foreign exchange spot rate.
Compounding returns across two entirely different vectors.
You can see why a heavily leveraged fund manager would find that irresistible. It creates this euphoric momentum in the market.
When algorithmic trading models and trend followers see that dual vector outperformance, they automatically allocate capital to the same trade, driving the high-yield currency up even further.
Everyone involved feels like an absolute genius because the line on the chart just keeps going up and to the right.
The appeal is undeniable because it is so incredibly intuitive and easy to quantify. An analyst can look at the central bank policy rates, examine the sovereign bond yields, pull up the forward rate spreads.
Which are essentially market bets on where interest rates will be in the future.
Exactly.
Yeah.
And plot it all on a terminal. It is highly visible.
The narrative practically writes itself. The currency is appreciating because the yield is superior.
It satisfies the human brain's desire for a clean, logical cause and effect relationship.
However, this euphoric feedback loop does not exist in a vacuum. A carry regime is highly fragile.
Extremely fragile.
It requires very specific, delicate conditions to survive. It needs a Goldilocks environment.
Yeah.
Not too volatile, not too unpredictable, just right.
Carry strategies are fundamentally allergic to volatility. They function optimally in environments characterized by highly predictable monetary policy and suppressed market turbulence.
When central banks are communicating stable, telegraphed policy trajectories and global macroeconomic data is relatively mundane, the risk models at major institutions flash green.
This is vital because, as we noted, these trades are heavily leveraged.
Let's expand on that leverage aspect, because it is the linchpin of the whole system. To make a 3 or 4% interest rate spread meaningful to a multi-billion-dollar fund, they are not trading one-to-one.
No, they are borrowing massively to amplify those returns.
And when you are highly leveraged, stability is not just a preference, it is a mathematical requirement for survival.
The technical concept here revolves around VAR, or value at risk. Institutional risk departments use VAR models to calculate the maximum potential loss a portfolio could suffer over a given time frame. When market volatility is exceptionally low, the VAR models calculate a lower risk of sudden, catastrophic currency movements.
This low volatility environment actually gives portfolio managers the institutional permission to increase their leverage, to take on even larger carry positions.
The quietness of the market actively encourages more borrowing.
So as long as the volatility stays low, the central banks remain predictable, and the global economy hums along without any major shocks, the carry traders are content.
They collect their yield.
They watch the currency appreciate. Their risk models tell them everything is perfectly safe. But the real story is the math of the carry trade eventually fails. And when it fails, it is absolutely catastrophic.
The failure is rarely subtle. This brings us to the fundamental vulnerability of yield, which we can call the illusion of high yield.
Despite the elegant math and the intuitive appeal of carry strategies, financial history is completely littered with examples where high-yield currencies do not just gently weaken.
They violently collapse. Yield is not the entire equation. It is merely one variable, and often it is a variable that masks deep underlying rot.
We have to look at the macroeconomic landmines that can instantly override a central bank's interest rate. It literally does not matter if a developing nation is offering you a 12% yield if that nation's economy is structurally imploding.
Yield becomes irrelevant in the face of existential risk. That is the core distinction between a safe return and a risk premium.
A nation might offer a massive interest rate, but you have to ask why.
Exactly. Why are they forced to offer such a high rate to attract capital? What if that country suddenly faces a severe constitutional crisis? What if there is a sudden, unexpected change in government that threatens to nationalize foreign assets?
Or consider an economic shock. What if a country's entire fiscal balance sheet relies on exporting a single commodity like copper or oil, and the global price of that commodity suddenly plummets by 40% due to a global recession?
In those scenarios, that high yield transforms from a steady stream of income into a financial trap.
When a systemic shock hits, whether it is a geopolitical crisis or an emerging market banking failure, institutional investors suddenly do not care about a 12% yield spread.
The mandate shifts instantly from generating return to return of capital.
They want their money out immediately. They liquidate their positions, withdraw their capital, and the currency goes into free fall, completely ignoring the attractive interest rates on offer.
The speed of that withdrawal is where the true systemic danger of the carry trade reveals itself. We have to dissect the mechanics of the violent unwind.
Because these positions are highly leveraged, a sudden spike in volatility, perhaps a global pandemic, a sudden credit freeze, or an unexpected geopolitical conflict instantly transforms those reliable profit engines into toxic liabilities.
The VAR models we discussed earlier suddenly reverse course. As volatility speaks, the models mandate that the funds drastically reduce their exposure.
Walk us through the anatomy of that panic. When the risk models start flashing red across every major banking desk in London, New York, and Tokyo, what does an unwind actually look like in the real plumbing of the market?
It resembles a desperate stampede for an incredibly narrow exit door. When the acceptable parameters of risk are breached, countless massive institutions are forced to close their carry trades simultaneously.
Consider the mechanics of closing that trade. You must sell the high-yield assets you previously purchased
Convert that capital.
and urgently repurchase the cheap funding currency that you originally borrowed simply to pay back the initial loan.
This is where the doom loop begins. Everyone is frantically dumping the high-yield emerging market bonds or the high-yield currencies simultaneously, which crushes their value.
Destroying the spot rate gains they had built up over years.
And at the exact same millisecond, everyone is desperately scrambling to buy back the cheap funding currency to cover their short positions, sending the value of that funding currency skyrocketing.
The simultaneous nature of this rush creates massive, rapid, and incredibly violent currency reversals. The funding currency, which may have been slowly grinding weaker for 5 solid years while the entire globe used it as a cheap ATM, suddenly surges upward in a matter of days or even hours.
Decades of slow, methodical capital deployment are violently unwound in a terrifying flash.
To really cement the sheer scale and destruction of this mechanism in your mind, we need to examine the ultimate historical case study, the yen carry trade cycle.
When you talk about the plumbing of global finance, Japan is the absolute epicenter of this phenomenon.
Japan provides the most profound, multi-decade example of how deeply these mechanics embed themselves in the global system.
Following the collapse of their asset bubble in the early 1990s, Japan faced decades of grinding deflation and stagnant economic growth. In a relentless effort to stimulate their domestic economy, the Bank of Japan instituted revolutionary monetary policies,
They pushed interest rates to zero and eventually into negative territory.
while also implementing yield curve control to artificially cap the yield on their government bonds. They effectively made borrowing the Japanese yen cheaper than any other capital on Earth.
The Bank of Japan essentially hung a neon sign over Tokyo saying, "Unlimited free money." And the global financial system responded exactly how you would expect.
The yen became the ultimate funding currency for the entire globe. It wasn't just a handful of esoteric hedge funds utilizing this. The widespread availability of zero-cost yen created a massive, interconnected, highly leveraged web of carry positions woven into the fabric of the global economy.
The sheer scale of the borrowing is difficult to conceptualize.
Institutional investors, multinational corporations, and even domestic Japanese retail investors, often colloquially referred to as Mrs. Watanabe in financial circles, were all engaged in this architecture.
They borrowed yen at near 0%, and they deployed that capital globally. They purchased high-yield sovereign debt in Latin America.
They funded massive commercial real estate ventures in Europe. And crucially, they funneled hundreds of billions of dollars into high-growth United States technology equities.
Visualize this dynamic. You have a relentless, roaring river of capital flowing out of Japan day after day, year after year.
Because this global network of investors is constantly borrowing yen and immediately selling it to buy US dollars or euros or pesos, the selling pressure keeps the Japanese yen artificially weak and incredibly stable.
It engineered the ultimate Goldilocks environment for a decade. The central bank was explicitly promising not to raise rates, and the volatility was suppressed by the constant outward flow.
The regime appears flawless as long as the global macroeconomic waters remain tranquil. But consider the immense hidden fragility of that architecture.
You have trillions of dollars of risk assets around the globe. Tech stocks, emerging market bonds, real estate that are secretly funded by short-term Japanese yen liabilities.
The foundational bedrock of the global rally is essentially a massive collective short position on the yen.
Which sets the stage for a spectacular chain reaction when a sudden global shock hits the system. Take a historical example, like the massive global market panics we saw in 1998, or the lead-up to the great financial crisis in 2007 and 2008, or even the intense market volatility of recent years. What happens when fear enters the broader equity or credit markets?
Let's zoom out for a
Oh,
second.
wait, no ellipses.
Let's zoom out for a second. The leverage becomes a weapon pointed at the investors. When a global shock triggers a broader market sell-off, the value of those U.S. tech equities or those emerging market bonds begins to drop.
The prime brokers issuing the leverage issue margin calls, demanding more collateral.
The investors, suddenly facing massive losses on their assets, are forced to liquidate. They must sell their tech stocks, take the resulting US dollars, and buy back Japanese yen to pay off their underlying zero-interest loans.
And because the entire global financial ecosystem is trying to squeeze through that same exit door, trying to buy yen at the exact same moment to cover their massive short positions, the yen spikes violently upward.
During times of severe global stress, the Japanese yen suddenly transforms into one of the strongest, fastest appreciating currencies on the planet.
And it is vital to understand this does not happen because Japan's domestic economy is suddenly booming.
It happens because of a massive, forced, mechanical repatriation of borrowed capital. It is a pure, unadulterated short squeeze on a global scale.
The cascading effects are profound. As the yen rapidly appreciates, the remaining carry trades become even more unprofitable, triggering further margin calls.
Forcing more liquidations of U.S. equities,
Huh.
which causes more yen buying, further driving up the currency.
This doom loop completely shatters the surface-level illusion that interest rate differentials are the only variable that matters. The currency offering the absolute lowest yield in the world suddenly becomes a wrecking ball that decimates leveraged portfolios across every continent.
While the carry trade and its eventual violent unwind perfectly explains the short-term yield-chasing behavior of the market, it falls short of explaining the true, long-term trajectory of global wealth.
If you are only looking at yield spreads and VAR models, you are missing the tectonic plates moving beneath the surface.
To understand why currencies embark on massive, multi-year trends that reshape the global economy, we have to move beyond the surface math entirely. We have to decode the hidden hand of the market.
We need to explore campaign logic.
Campaign logic is the framework that separates reactionary trading from true macroeconomic positioning. A market campaign refers to a sustained, methodical period of institutional capital deployment centered around a massive macroeconomic theme or a structural global shift.
The contrast with the carry trade is stark. Carry trades are frequently short-term, opportunistic, yield-chasing endeavors that are highly vulnerable to the slightest breeze of market volatility.
Campaigns, inversely, unfold over extended horizons. We are talking many months or, more often, several years.
They're constructed on the foundational conviction that the underlying architecture of the global economy is shifting, and that those shifts will mandate a persistent, undeniable movement of capital into a specific currency.
We are stepping away from the day traders trying to scalp a few basis points of yield on a Tuesday afternoon. To understand a campaign, we have to understand the entities executing them.
Who are the apex predators of the foreign exchange ecosystem? Who has the capacity to wage a multi-year campaign?
We are examining the true titans of global finance. This includes the massive global macro hedge funds that manage tens, sometimes hundreds, of billions of dollars.
It includes the sovereign wealth funds, entities managing the accumulated wealth of entire nations, like the massive funds out of Norway or the Middle East, which control hundreds of billions of dollars in deployable capital.
It encompasses the giant, multi-trillion-dollar asset management firms. And critically, it involves the central banks themselves, actively managing their nation's vast foreign exchange reserves to protect their domestic economies.
The sheer incomprehensible scale of the capital these entities control fundamentally changes their relationship with the market. When players of this magnitude decide to reallocate their portfolios, they do not just participate in the market's current trend.
They generate the trend.
Their coordinated directional movements carry such immense gravitational mass that they can literally dictate a currency's trajectory for half a decade.
But a sovereign wealth fund does not just wake up and arbitrarily decide to buy $50 billion of a specific currency. What constitutes the why?
Right. The why is rooted in structural incentives. Yield, while occasionally a secondary benefit, is not the primary driver for a campaign.
These institutions are analyzing monumental structural shifts. They are identifying massive divergences in long-term monetary policy between the world's largest economies.
They are positioning themselves for decade-long commodity supercycles, such as a fundamental deficit in global copper supply or a structural shift in global energy reliance.
They are tracking immense geopolitical realignments, observing where global supply chains are being physically dismantled and rebuilt in different hemispheres.
Above all, they are analyzing the shifting tides of global liquidity, tracking the actual plumbing of the international financial system to see where money must structurally flow to keep the global economy functioning.
That brings up a fascinating logistical challenge. Let's say an apex predator, a massive macro fund or a sovereign wealth manager, identifies a structural shift.
They determined that a massive rewiring of global energy supply chains is going to overwhelmingly benefit a specific currency over the next 4 years. How do they actually execute that thesis?
If a retail trader wants to buy $10,000 of a currency, they click a button on their phone. But if an institution needs to acquire $80 billion of a currency to establish their campaign, they cannot simply click a market buy order.
The sheer volume would instantly obliterate the liquidity, cause the price to skyrocket, and completely ruin their own average entry price.
The execution of a campaign is an intricate art form in itself. Institutions of this magnitude must be exceptionally meticulous to obscure their massive footprints from the rest of the market.
True institutional campaigns almost never commence with dramatic, flashing price movements or breaking news headlines on financial television.
Instead, the primary tactic is gradual, relentless accumulation. They build their massive positions slowly, methodically, utilizing advanced algorithms to slice their massive orders into thousands of microscopic pieces.
Utilizing volume-weighted or time-weighted average price strategies, executing them over weeks or months.
They are essentially sneaking their capital into the theater while the lights are still down, long before the previews have even started.
And they do this by utilizing periods of market weakness or sideways consolidation, right? This highlights a massive behavioral difference between a leveraged carry trader and an institution executing a campaign.
That behavioral divergence is the clearest tell in the market. Recall how a leveraged carry trader reacts to a sudden market drop. Their risk models flash, they face margin calls, and they panic, liquidating their position.
They are shaken out of the market.
But an institution managing a multi-year campaign views a market drop through an entirely different lens. They embrace the dips.
Because to a sovereign wealth fund accumulating a massive position, a drop in price isn't a crisis. It is a wholesale discount on an asset they already plan to buy.
Precisely the right framework. Campaigns aggressively eat pullbacks.
Instead of panicking during moments of broader market weakness, these institutions utilize the enhanced liquidity provided by panicked retail and carry traders to aggressively add to their campaign positions at significantly better prices.
This relentless absorption of supply creates a very distinct pattern of persistent directional movement over time. The market may take 2 steps forward and 1 step back.
But that 1 step back is immediately met with a wall of massive institutional capital, effectively establishing a floor under the currency and reinforcing the long-term structural trend. Now here's where it gets interesting. Because these two distinct worlds, the highly intuitive surface-level yield-chasing carry trade and the deep, structurally driven hidden campaign logic, they do not exist in separate universes.
They operate simultaneously within the exact same market.
And when campaigns and carry dynamics collide, that is when you witness the true, unvarnished reality of how global markets actually function. Let's dissect what happens when these forces interact.
The interaction between carry and campaign logic produces the most powerful dynamics in all of macro finance. On rare occasions, these two forces align perfectly.
You have a currency that possesses brilliant long-term structural macro incentives driving a massive institutional campaign. And simultaneously, the central bank of that specific currency is aggressively raising interest rates, making it an incredibly attractive carry trade for the broader market.
When you have that perfect alignment, the attractive carry yield effectively acts as high-octane campaign fuel.
It acts as a massive compounding accelerant.
The high-yield differential becomes a lucrative additional reward for the institutions that were already accumulating the position purely for structural macroeconomic reasons.
They are essentially being paid a handsome interest rate simply to sit and wait for their long-term structural thesis to fully materialize.
Furthermore, because the yield is highly visible and attractive, it serves as a beacon, drawing in the entire spectrum of market participants. The retail traders, the momentum algorithms, the fast money hedge funds.
This convergence creates an incredibly powerful, unified tsunami of capital inflow that can drive a currency to historic, multi-decade highs.
However, and this is the vital concept for anyone trying to decode the matrix, institutional campaigns do not require the math of the carry trade to succeed.
In fact, some of the most powerful macro campaigns in history completely defy the surface-level math. We have seen massive currency appreciation in environments where the yield offered was absolutely terrible compared to the rest of the world.
That dynamic is exactly where the pure, simplistic carry trade narrative completely disintegrates. Financial history is rife with anomalies where currencies have strengthened relentlessly, completely ignoring the fact that they offered significantly lower yields than their global counterparts.
This forces us to ask a deeply logical question. Why would a highly sophisticated giant institution deploy $50 billion into a currency that pays essentially 0% interest when they could effortlessly capture a 5 or 6% guaranteed yield somewhere else?
Because entities operating at the absolute apex of global finance prioritize objectives that supersede a few percentage points of interest yield. They are solving for existential equations.
Often, they require immense, unfathomable liquidity, the ability to move billions of dollars in a matter of seconds without shifting the market price against themselves.
Certain currencies, primarily the US dollar, offer a depth of liquidity that no high-yield emerging market could ever dream of providing.
Alternatively, they prioritize absolute systemic safety. The ironclad assurance that their sovereign capital is secure even if the global banking system is experiencing severe stress.
Or they are executing a broader macroeconomic hedge, positioning their currency exposure to counterbalance a specific global risk in their broader portfolio. When those structural existential needs reach a critical threshold, yield becomes an entirely irrelevant metric.
Let's bring this abstract concept into sharp reality with a massive recent case study that perfectly illustrates this phenomenon. We need to dissect the United States dollar strength cycle that dominated the global markets from 2021 through 2023. Let's reconstruct the environment.
Set the global macroeconomic scene for us as we enter the early 2020s. The macroeconomic backdrop was defined by unprecedented global instability.
The world was attempting to navigate the chaotic aftermath of a global pandemic. The physical plumbing of global trade was fractured.
We witnessed massive supply chain chaos, with vital components stranded, shipping routes paralyzed, and manufacturing hubs intermittently shutting down.
Compounding this, we experienced sudden, severe energy shocks, drastically altering the cost of industrial production globally.
The unavoidable consequence of this massive disruption to supply, coupled with historic fiscal stimulus, was a resurgence of inflation to levels the developed world had not experienced in 4 decades.
It was an era of profound uncertainty. And in direct response to that raging inflation, the United States Federal Reserve was forced to abruptly abandon its accommodative stance and begin aggressively tightening monetary policy.
They embarked on a cycle of raising interest rates faster and more aggressively than almost any other major central bank in the world.
The Federal Reserve's aggressive hiking cycle rapidly expanded the yield advantage of dollar-denominated assets. Now, if you tuned into mainstream financial media during this specific period, the narrative being broadcast was incredibly uniform and straightforward.
The U.S. dollar is surging because U.S. interest rates are rising. It is a textbook carry trade. Buy the dollar, collect the high yield.
Every analyst with a microphone was pointing to the yield spread graphic on their screen. The math says the dollar goes up. But that simplified narrative was completely blind to the deeper, far more powerful structural reality operating beneath the surface, wasn't it?
Completely blind. Let's aggressively deconstruct that mainstream narrative. Why was the relentless rise of the dollar actually a massive, structurally driven institutional campaign, rather than just a simple interest rate play?
Because the sheer velocity, scale, and persistence of the U.S. dollar's appreciation vastly exceeded what a simple interest rate differential could logically justify.
Did the rising yield help? Absolutely. As we discussed, it functioned as excellent campaign fuel, drawing in speculative capital. But the primary overwhelming driver was a phenomenon known as global liquidity stress.
Manifesting as a structural global dollar shortage. Break that concept down into the actual plumbing of the market. What does a structural global dollar shortage actually mean for a multinational corporation or a foreign government?
It means the global economic system was terrified, and the bedrock of that system functions exclusively on U.S. dollars. When international supply chains shatter, and when the price of global energy commodities, which are universally priced in dollars, suddenly skyrockets, foreign entities are thrown into crisis.
Imagine you are a massive industrial manufacturer in Germany or a sovereign government in Asia. Suddenly, your energy import costs have quadrupled.
You urgently require a massive influx of U.S. dollars simply to secure the resources necessary to keep your economy functioning. To service your existing massive dollar-denominated offshore debt, often referred to as the euro-dollar market, and to fortify your deteriorating balance sheets against further shocks.
In this environment, the U.S. dollar ceases to be merely a currency. It becomes the vital oxygen of the global financial system. It operates as the ultimate, irreplaceable, safe haven asset.
So while the retail trading public and the television analysts were hyper-focused on a 3% yield spread, the true apex predators, The foreign central banks, the massive international corporations, the macro funds were executing a desperate, relentless structural campaign to hoard U.S. dollars.
Not because the Federal Reserve was paying them a nice dividend, but because they required systemic safety and absolute liquidity in a world that felt like it was fundamentally fracturing.
Exactly the right synthesis.
Hmm.
They were acquiring the dollar because their structural survival mandated it, not because it offered an attractive carry. And this dynamic exposes one of the most dangerous traps for any investor trying to understand macrofinance.
The late cycle illusion. This is such a vital concept to grasp. Explain the mechanics of this illusion and how it traps the unwary investor.
The late cycle illusion describes the phenomenon where the simplistic carry narrative only gains traction in the mainstream financial media after a massive institutional campaign has already been fully underway for an extended period.
The apex predators, the institutions analyzing the structural supply chain breakdowns and the euro-dollar liquidity stress, have been quietly, methodically accumulating their massive dollar positions for many months.
Then the central bank finally reacts to the inflation data and begins aggressively raising interest rates. The currency experiences a sharp, volatile upward spike.
Only then does the media notice the expanding yield spread and begin heavily promoting the obvious carry trade narrative to the public.
By the time you hear a pundit on the news explaining why the interest rate math makes a currency a sure thing, the smart institutional money has already constructed their massive position.
They are no longer buying. They are simply sitting back and riding the wave of retail and late-stage institutional capital that the media narrative is actively generating.
The structural forces driving the campaign were firmly in place long before the media ever noticed the yield spread graphic.
If your investment thesis is purely reactive to the visible yield, you are mathematically guaranteed to be late to the structural macro movement. You are buying the top of the campaign while the institutions are preparing to slowly distribute their positions to the latecomers.
So the ultimate question becomes, what does this all mean for you, the listener? How do you actually train yourself to spot the matrix?
How do you differentiate between a fleeting, deeply fragile carry regime and a massive foundational structural campaign? Let's equip you with a concrete mental checklist. Let's outline the specific fingerprints of a carry-dominated environment first.
If you are observing a currency movement driven predominantly by yield-chasing carry dynamics, you will generally identify three distinct characteristics. First, the broader market environment will exhibit low volatility. The VAR models are calm.
Second, you will observe highly telegraphed, predictable central bank policies with no unexpected hawkish or dovish surprises.
But the third, and absolute most critical identifier, is the price action during a sudden market shock. In a pure carry regime, the moment there is a spike in fear or a negative data print, the high-yield currency will retreat incredibly violently.
It will gap downward as all the highly leveraged participants simultaneously rush for the narrow exit door to avoid margin calls.
Okay, so a pure carry environment is characterized by low volatility, high predictability, but it possesses glass jaw fragility. It panics and collapses at the very first sign of genuine trouble.
Now contrast that. What are the identifiable fingerprints of a structural campaign? How do we spot the apex predators at work?
Campaigns leave an entirely different forensic trail in the market data. First, the directional trends are incredibly persistent. We are not analyzing a 2-week momentum rally. We are tracking multi-month or multi-year trajectories that seem to defy gravity.
Second, these movements are always underpinned by dominant foundational macro narratives. Major structural shifts in global commodities supplies, massive long-term divergences in sovereign bond markets, or deep systemic liquidity imbalances in the offshore banking system.
However, the ultimate undeniable tell of an institutional campaign is the liquidity behavior during market pullbacks.
Right. It all comes back to how the market handles the dips.
The behavior during a dip reveals the true nature of the participants. In a campaign-driven market, when negative news hits or a technical pullback occurs, you absolutely do not witness a panicked rush to the exits.
Instead, you observe relentless, methodical buying. The currency might dip for a trading session or two, but that downward movement is immediately absorbed by massive walls of institutional capital, utilizing the weakness to reinforce their long-term positions.
Pullbacks are remarkably shallow, and the subsequent recoveries are aggressive and sustained.
So, if you are analyzing a currency that absorbs terrible macroeconomic news, shrugs off negative headlines, and just relentlessly, methodically grinds higher every single time it dips, you are not looking at a fragile carry trade.
You are witnessing a massive structural campaign unfolding in real time.
But this raises a glaring contradiction. If the fingerprints of a campaign are this clear when you know what to look for, why does mainstream financial commentary get this wrong with such stunning regularity? Why is the danger of simplicity so pervasive in the media?
The failure is inherent to the medium itself. Financial media is fundamentally structurally constrained. It operates on rapid sound bites, short attention spans, and simple, highly visual graphics.
Yield spreads are a producer's dream because they are wonderfully simple and visually intuitive. You can place the flag of one nation next to a 5% yield and the flag of another nation next to a 0% yield, and the viewer instantly comprehends the core premise.
It is a narrative that fits flawlessly into a tightly scripted 3-minute television segment between commercial breaks.
It is easily digestible financial fast food. It makes the viewer feel informed without requiring them to do any heavy intellectual lifting.
Conversely, the structural shifts in global capital that drive true campaigns are inherently dense and incredibly complex. They are hidden deep within the esoteric plumbing of the financial system.
Attempting to clearly explain the intricate interplay between offshore eurodollar futures markets, the physical realities of geopolitical supply chain rewiring, and the long-term capital expenditure cycles of global commodity producers that simply does not fit on a flashy, color-coded TV graphic.
It requires deep nuance, historical context, and significant time to properly unpack.
Furthermore, as we have heavily emphasized, the institutions executing these campaigns are actively incentivized to remain invisible. They do not issue press releases announcing we have identified a structural dollar shortage and will be quietly accumulating $50 billion of exposure over the next 8 months.
Because the true drivers are hidden, analysts inevitably lean on the most visible, easily accessible data point, which is the central bank interest rate, even when it is the completely incorrect explanation for the underlying market movement.
That reality leads us to the ultimate lesson of understanding global capital flows. Interest rates undoubtedly matter. They possess significant influence over short-term speculative capital flows, they can act as powerful accelerants to existing trends, and they remain a vital component of any currency valuation model.
However, treating central bank interest rates as the sole driver of foreign exchange is a fatal analytical flaw.
It is a mental model that will inevitably lead you to allocate capital into deeply fragile, leveraged structures right before they violently collapse.
And equally importantly, it will completely blind you to massive generational movements of global wealth simply because the surface-level yield did not look attractive enough on a spreadsheet.
Therefore, the challenge for you, as you analyze the global markets going forward, is to actively train your mind to look past the surface-level math. Demand a deeper explanation than simply the yield is higher.
Always search for the structural incentives. Attempt to identify the specific phase of a campaign.
Are we currently in the stealthy, gradual accumulation phase where the massive pools of smart money are quietly buying every dip while the media ignores the currency?
Are we transitioning into the narrative expansion phase, where the broader institutional market is beginning to recognize the macro shift?
Or are we in the dangerous, broad participation phase where every retail trader is piling in and the financial television pundits are calling it an obvious carry trade?
By rigorously applying those analytical questions, you fundamentally elevate your perspective. You transition from being a reactive, short-term participant obsessing over a central bank spreadsheet to a strategic macro thinker who understands the true, deep architecture of global wealth.
You stop asking the simplistic question of who pays the highest yield right now, and you begin asking the profound question, where must global capital structurally move to survive over the next 5 years, and why?
And shifting that framework changes absolutely everything about how you view the world.
We have covered an immense amount of ground today. We initiated our journey at the surface, examining the intuitive mathematical allure of the carry trade, how borrowing cheap capital to acquire high-yield assets engineers a euphoric, self-fulfilling behavioral feedback loop.
But then we deconstructed that math to expose its extreme fragility. We explored how sudden geopolitical shocks, spikes in volatility, or credit crises can trigger a terrifying, violent unwind.
Instantly transforming high-yield dreams into leveraged nightmares, exactly as we analyzed with the historical, massive mechanical squeezes of the Japanese yen.
From that understanding of fragility, we descended into the deeper, far more powerful mechanics of the market. We unpacked the concept of campaign logic.
We analyzed how the apex predators, the sovereign wealth funds and global macro giants, do not chase fleeting daily yields, but rather deploy unimaginable amounts of capital over multi-year horizons based on profound structural shifts in global liquidity, massive commodity supercycles, and long-term monetary policy divergences.
We analyzed how these massive institutional campaigns can utilize the carry yield as a powerful accelerant, but more importantly, how they can completely defy the surface math when institutions prioritize ultimate systemic safety, repo market access, and deep liquidity over a few points of interest.
Perfectly illustrated by the massive, structurally driven US dollar strength cycle we witnessed as global supply chains fractured in recent years, you now possess the analytical mental models to spot the vital difference between a fragile, yield-driven trap waiting to collapse and a relentless, structurally driven institutional campaign.
The surface-level math explains the day-to-day noise and the reactionary volatility, but the structural logic explains the decade.
That is the perfect synthesis. The structure explains the decade. And I want to leave you with a final provocative thought, something to deeply consider as you observe the geopolitical and economic news flowing across your screens this week.
Think about the massive hidden structural campaigns that are undoubtedly being assembled right now, deep beneath the surface of the current market.
As global supply chains actively and aggressively rewire themselves across entirely new hemispheres, and as unprecedented geopolitical alliances are forged to secure critical next-generation energy and technology resources, what happens when the ultimate safe haven campaigns of today begin to quietly, methodically unwind?
The next great generational transfer of global wealth is not going to be announced with a flashy interest rate hike graphic on financial television.
It will be initiated as a silent, methodical campaign, and now you know exactly what to look for.
The forensic clues of the next massive shift are already leaving footprints in the market structure if you have the framework to read them.
Thank you so much for joining us on this deep dive into the matrix of global capital. Keep questioning the surface narrative, aggressively look for the hidden structural incentives, and we will catch you next time as we continue to unpack the massive, unseen forces that shape our world. Take care.